Right, traders, welcome back to the channel. Here we have the GBP USD chart in front of us. And on this chart today, we're going to be dissecting a case study that was a trade that was taken earlier on in the week. And we're going to be looking at how you can get involved in this market, right? So a GBP USD case study, right? So where do we begin when it comes to looking at price? We start on the daily time frame, of course. So this is the daily time frame. And there's a couple of things I want to bring to your attention right away when it comes to building a narrative in price. We have a structure that's pretty much bullish, right? So we've understood we've had a structural break over here. And now because of that, we are bullish, right? So we have a bullish dealing range to work with, right? From this swing low up to this swing high. So now what we need to know is we need to see that we bounced off a POI over here. So this POI in the discounted POI over here is what gave this bullish reaction. So this bullish reaction allowed price to essentially get up to this level over here. So now in price, I have a bullish narrative on GBP USD. And where does that bullish narrative come from? Well, there's a few things we need to look at. The first thing to understand is that we have a fair value gap just over here. So we have a fair value gap over here. This is an inefficiency in price, right? This is an inefficiency in price. So price will look to target areas of inefficiencies above us, okay? The next thing to understand is that this inefficiency over here therefore gives rise to this POI. Now this POI is in in premium, deep premium over here, right? We're in deep premium, right? So now we need to understand that we've reacted off a bullish POI over here, which left a fair value gap in the discount. Now, the way that IPTA works, the interbank price delivery algorithm, is that it seeks for buy side liquidity and fair value gaps in deep premium. So discount to premium or premium to discount if we're looking for sales, right? So in this case, we understand we've reacted off a discount into a premium. And now my overall target is for price to get up to this zone over here. So to give people an indication of that, that is looking at the price point of 1.305, okay, where this fair value gap is in price. So now that we've identified a bullish narrative, we're now going to go down to the lower time frames or the 15-minute time frame over here for entry to keep things nice and basic. So now that we have gone down a time frame, we're going to be looking to dissect this trade over here, this buy trade over here, okay? Starting with our accumulation, manipulation, and distribution. How can you use ICT's famous AMD model or Power of Three model to get involved in the financial markets here on GBP USD? Right, let's go through a quick schematic before we get involved in this market, right? So what we have is we have what we call an Asian range over here. So the Asian range accumulates liquidity, right? The Asian range accumulates liquidity. So what's the purpose of the Asian range, right? So the Asian range is essentially a low volume time a day that builds liquidity. Now, one question I always get a lot is, what is the timing of the Asian range? So the Asian range is from 8 p.m. to New York midnight in New York, right? Eastern Standard Time, right? So the Asian range accumulates liquidity, right? Now, the London session has a purpose to do. If we're looking to go higher, right, price will sweep below the Asian range low. So this is the Asian low. Why would price do that before aggressively moving upwards? So why would price sweep this Asian low over here, this red line, or the Asian range low, the ARL, the Asian range low? Why would price look to do that? Now, the reason why price would do that is very simply to trap early sellers into the market or just trap sellers into the whole as a market, right? Give them FOMO. And this creates what we call the Judas swing or the low of the day or the manipulation or the turtle soup. Many names, but they all mean the same thing. The Judas swing very typically occurs in the London session and represents the low of the day or the LOTD, right? The low of the day. So when we see a Judas swing operating in the London session, what this represents is a high volume time of day which manipulates sellers into the market, right? Sweeping the Asian low. Now, as a trader, we're going to be looking to enter off a bullish order block. We need a bullish order block. So what does a bullish order block entail of? Let's just say hypothetically, this is our bullish order block over here in gray. What does this bullish order block actually need to do? What does it need to represent? Well, it needs to do a few things. It needs to break structure. That's the first thing. So we see a shift in market structure, MSS, or market structure shift, MSS. Okay. We need to see it being priced in the discount, and we need to see it leave a fair value gap. So those are the three things we're looking for when it comes to entry. Three things, right? One, two, three. Very systematic, very clean, very mechanical. You can't really mess this up unless you have a discipline problem. You can't really mess this up. So the first thing we're looking for is we're looking for a clean break of structure or a market structure shift, MSS. The second thing we're looking for is a fair value gap in price or an inefficiency, which price will look to rebalance before going higher. And the third thing we're looking for is for price to be in the discount. These are three things we're looking for. So as price breaks structure to the upside and rebalances, we're going to be looking for it to fill a fair value gap before we look to buy again, right? Before we look to buy again. And this is how we do it. So we have our stop loss below the low of the day, the Judah swing, typically, and we look to target areas that have left inefficiency, sell side inefficiency above us. So this is the basic framework that we use as ICT traders to get involved in the market. Here's how we do it. Right. Look at how price operates in the Asian session. We have a relatively low volume time of day over here. This is the Asian range over here, marked out in gray. So this is the Asian range. Asian range. So the Asian range represents a low volume time of day. And look what price does. We see a sweep of the Asian low over here. So in red represents the Asian low. So the Asian low sweeps liquidity and it produces what we call the Judah swing over here. Now, when it comes to identifying the Judah swing is always in yellow, as my chart suggests. The Judah swing here represents the low of the day before we see price break structure to the upside. So we see a break of structure over here, and we see a break of structure over here. So this is our first break of structure. This is like our change of character. This is our break of structure, both to the upside. So now that we've seen that, what we're looking for now is a time-based fair value gap to enter off. We need a time-based fair value gap to enter off, right? Now, before we find that, I just want to bring your attention to a few things. When price breaks the Asian range low, when price sweeps below the Asian range low, and we have not one, but two breaks of structure to the upside, what do we expect price to do? We expect price to follow on this trend, and the reason why is because we're bullish on the higher time frames. It's that simple, right? So now, where's our fair value gap? Where's our time-based fair value gap to enter off? Look at this candle over here. So this candle was formed at 3 p.m. UK time, which corresponds to 10 a.m. Eastern. Okay, when we have a fair value gap that forms in our session, that represents a time-based fair value gap. So what is the New York session that we want to be trading from? New York session, New York time is going to be from 7 a.m. to 10 a.m. Eastern Standard Time, right? So because of that, we have a 10 a.m. Eastern Standard Time fair value gap over here, right? So this therefore makes our entry valid. So we want to enter off this fair value gap just over here. Now, a safe place to keep your stop loss is either going to be below this wick over here, below any inefficiencies in price, or you can have your stop loss over here. It really doesn't matter, giving you a 20 pip stop loss or a 15 pip stop loss or a 17 pip stop loss, which is absolutely fine. You don't want to go below 10 pips, otherwise you're just chasing a stupid RR, which isn't needed. And you have a nice 1 to 2 trade over here, targeting the H4 premium POI over here, giving you a nice 1 to 2 or 1 to 3 hour trade, depending on your stop loss size, right? And as you can see, this really went to a swing trade, swing position over here. So a very quick GBP USD breakdown using the basic rules of accumulation, manipulation, and distribution, all coming back to this framework over here. So this framework works on an accumulation model, right? Understanding an accumulation of the Asian range, understanding how price will sweep the Asian low, enticing sellers before they ultimately get swept out, and we want to enter off a fair value gap over here. And that's exactly what price has done over here. So a very quick overview on GBP USD at Liquid FX. So if you like this video, give it a like and thumbs up, and I look forward to seeing you all in the next one.